The 2000s housing bubble in the United States stands as a stark reminder of the dangers of unchecked speculation and financial instability. This period, marked by a dramatic rise in housing prices followed by a devastating collapse, had a profound impact on the American economy and continues to be felt today. Easy money fuels a frenzy. The story begins in the early 2000s. Interest rates were low, and a combination of government policies and lending practices made it easier for many Americans to obtain mortgages, even those with weak credit histories. This, coupled with a belief that housing prices would only ever go up, fueled a buying frenzy. Demand surged, and housing prices skyrocketed across the country. A house of cards, subprime mortgages, and risky loans. At the heart of the bubble lay a dangerous trend: subprime mortgages. These loans were issued to borrowers with poor creditworthiness, carrying higher interest rates and greater risk of default. Financial institutions further exacerbated the problem by bundling these risky mortgages into complex financial instruments called mortgage-backed securities, which were then sold to investors worldwide. The illusion of sustainability. As housing prices continued to climb, speculation ran rampant. Flipping houses, buying, making quick renovations, and reselling for a profit became a popular strategy. The focus shifted from the value of the underlying property to the potential for short-term gains. This unsustainable model ignored the true value of homes and the borrower's ability to repay their loans. The burst and the Great Recession. The bubble couldn't last forever. By 2006, interest rates began to rise, and as housing prices started to plateau or even decline, many homeowners found themselves underwater, owing more on their mortgages than their homes were worth. This triggered a wave of defaults, foreclosures, and a rapid decline in housing prices. The financial crisis that followed, known as the Great Recession, plunged the U.S. economy into a deep downturn. A decade later, the lingering effects. The scars of the housing bubble are still visible today. Millions of Americans lost their homes, and the financial crisis led to widespread job losses and economic hardship. The housing market took years to recover, and regulations on mortgage lending were tightened to prevent similar situations in the future. Lessons learned: a call for caution. The 2000s housing bubble serves as a cautionary tale. It highlights the dangers of unchecked speculation, lax lending practices, and the disconnect between asset prices and their underlying value. The episode underscores the importance of responsible financial practices, regulations that promote stability, and a focus on the long-term health of the housing market over short-term gains. A complex story with lasting impact. The story of the housing bubble is multifaceted, with contributing factors ranging from government policies to individual choices. Understanding this complex episode in American economic history remains crucial to preventing similar crises in the future and ensuring a more stable and sustainable housing market.